Okay, here we are on Chapter 5, and this is a merchandising business. It's a little bit different than a service business when we're accounting for it. So let's answer these 4 questions and see if this helps a little bit. First of all, we're going to answer what is a merchandising business. We're going to look at the difference between the two, and we're going to look at how the accounting changes for a merchandise business. And finally, we're going to look at what's new on the financial statements. So let's look at where we've been and where we're going. This is where we've been. We've been in the accounting cycle. We've looked at journalizing and trial balances and financial statements, adjusting, and oh no, closing entries. So now we're going to dive deeper into this. What we looked at here basically was for a service industry. Everything's the same. Except for when we get to a merchandise business, we add inventory, and that adds a few other accounts. We have to worry about FOB shipping point, FOB destination. We're looking at 2 different ways of keeping track of your inventory, periodic and perpetual. And then we're looking at different ways of doing the financial statements. We have some new accounts we're going to look at. We're going to look at inventory, sales discounts, sales returns and allowances, delivery expenses, cost of the merchandise sold, and gross profit. And also we'll take a peek at the sales tax payable. So that's kind of an overview of where we're headed. First of all, let's look at the nature of a merchandising business. And it adds that extra cycle, okay? First of all, we use our cash to purchase merchandise. Then we sell it. Then we usually have an accounts receivable, and we collect from that, and it comes back to our cash. So what's different here is it sells a product, it has inventory, there are different transactions, and it's a different business cycle. So when you're looking at a service, we go cash, right? Delivery of the service, cash, and then right back. You just go cash, sales, maybe accounts receivable, and then back to cash. It's a shorter cycle. So in the financials statements, the difference is we've added an extra step. So now we have to keep track of how much that inventory costs. So when we were doing a service business, we had fees minus the operating expenses, and then we had net income. Now we're going to have sales, and we're going to deduct the cost of the inventory, or the cost of merchandise sold, just the inventory that was sold. And we've added a new placeholder here. It's called gross profit. Then, after the gross profit, we subtract the operating expenses. So we use a little bit more complex accounting system. And with that, we have a few more subsidiaries. Now, we already had the accounts receivable subsidiary ledger that keeps track of the customers, and we had the accounts payable, which keeps track of our creditors. Now we're going to have an inventory subsidiary ledger, and that is going to keep track of our individual inventory. We won't delve into this very deeply, but I want you to be aware of these terms. And finally, we're going to look at inventory. And inventory can be handled in 2 ways. You can have it as a perpetual inventory system, which means I always know what is on hand. I keep a running total of my inventory. Or we can do a periodic, which means I don't count my inventory till the end of the period, and I really don't know how much inventory I have out there at any one time. So most places are now using the perpetual system because of the advent of using computers. So we have a few transactions that have changed now. So under the perpetual inventory system, we have added this. I'm going to buy inventory, and I'm going to use cash for it. So I have to debit my inventory, and I'm going to credit my cash. Now, most people don't pay cash unless they're using their credit card. Most people will use an accounts payable. They'll charge it. So in that case, you would debit your inventory and credit your accounts payable. So, and then when you went to sell this, if you're using a perpetual system, I would show the sales, cash, I received $1,800, and sales, I've recorded it. But since I'm using perpetual system, I also record how much that inventory cost me. I sold it for $1,800, but it cost me $1,200. So this becomes a cost of merchandise sold, which is kind of an expense, right? So it's debited. And we credit the inventory to remove that out of inventory. So we know we don't have any more of we've reduced our inventory in that case. Now sometimes our customers return it. So I returned this, and I sold this, okay, and my customer returned it. So now I've taken it out of accounts receivable as the credit and put it into refunds payable. And that's a viable way to do it. Sometimes you literally will debit your inventory and credit the accounts receivable and send out a memo on it. So there's all kinds of ways. In the assignments, I'm going to show you a couple of ways to handle these entries, so don't memorize these. When you're looking at freight, you're going to have two ways of doing it. You've got terms FOB shipping point, which means I take control of it because I bought it as a buyer, and I'm responsible for it from the place it ships. And then you have FOB destination, which means the title or the possession of the inventory doesn't occur until it gets to the buyer. Usually the seller is responsible for this. And the same thing here, but the buyer is responsible for that freight. That becomes important to figure out who's going to pay for it in case something happened, and who pays the freight. Various ways of handling who pays for it. It could be an agreement, and in this case, they bought $900 worth of merchandise. So they show that going into their inventory for $900 and accounts payable. And then they paid the cost on that themselves to the shipper. So they've increased their merchandise inventory and credited cash. So this inventory actually cost $950. And if I turn this around the same day and sell it, the cost of merchandise sold would be $950. That's one way of handling it. Another way of handling it is they've sold $700 worth of inventory. Oh, no, wait a minute. This is, I take that back. This is also showing you the sale and recording of the cost of merchandise sold. So here, I've sold it for $700. They've charged it. I've recorded the cost of merchandise sold for $480 and remove that from my inventory. And then I've also recorded a delivery expense that I paid for this, shipping costs. So I paid for it to their destination. And so I just show that as a delivery expense. That's another way of working on this. And here's one more way. And this one is I'm doing the sale as normal, $800, and here's my cost of goods sold. But here I'm actually charging the buyer for it by putting it into their accounts receivable. So there's various ways that can be charged to a customer. And here is an example of how the inventory and the sales transactions are different between the seller and the buyer. So here we've recorded the inventory. I've recorded the cost of merchandise. Here we've recorded receiving the inventory, and I put it into my accounts payable. So there's no journal entry for freight because the buyer is paying for it. And here they've literally just sold some more, and here's their entry as a seller, and here's their entry as a buyer. You can see there it's very simple. Here's another way. Here they're showing it as a delivery expense. Now, all of this is dependent on the agreement between the buyer and the seller. In this one, they've received a payment, so they've received cash, and it comes off their accounts receivable. On the buyer's side, they show a decrease in cash and a decrease in their accounts payable. They just kind of mirror each other. And here they come up with one with a discount on it. Now I'm going to show you two ways of doing those. So I'm not going to explain this one. I'm going to wait until we get into the participation points for that. And then finally they receive payment of this transaction here. So there are various ways, and it all depends on how the agreement between the buyer and the seller. And I'm going to stop right here because I'm running up to 10 minutes and I really don't like to go over that. So I'm going to show you how to do the chart of accounts and the financial statements on the next one. So part 1 of 5.